The United States government just crossed a line that would have been unthinkable a generation ago. It now spends more money paying interest on its debt than it spends on its entire military. More on interest than on national defense. That is not a forecast. That has already happened. And almost nobody is positioning a portfolio for what it means. I am going to walk you through 3 publicly traded ways to position for a government that is now spending a fortune simply to service what it already owes. Not a single bond, and not a bet on guessing the next move of one central bank. Not a generic bond fund that owns 100 maturities and a strong view on none of them. Real exposure, structured around a slow, grinding structural force. A debt load so large that the interest on it has become one of the biggest line items in the entire federal budget. This is not a crisis that arrives on a single dramatic day. It is a pressure that builds quarter after quarter until the market is forced to reckon with it. The trade I want to show you is simple. Do not try to time the exact moment the pressure breaks. Position for the direction the pressure pushes, and own the assets that benefit as it builds. Let's get into it. First, a level set, because you cannot trade a thesis you do not understand. The story you have heard is the national debt is big. The story underneath is a specific mechanical trap, and it has 3 moving parts. Part 1, the debt itself. The United States government spends more than it collects in taxes every year, and it has for a long time. It covers the gap by borrowing, by issuing treasury bonds. Decades of those annual gaps have stacked into a total debt now measured in the tens of trillions of dollars. Part 2, the interest rate. For most of the last 15 years, that enormous debt was strangely cheap to carry because interest rates were pinned near zero. A vast debt at a near zero rate produces a manageable interest bill. Then inflation arrived, and to fight it, interest rates were pushed sharply higher. Part 3, the refinancing. Government debt is not borrowed once forever. Bonds come due, and when they do, the government must borrow again to pay them off. It refinances. So as the old, cheap, near-zero rate bonds mature, they are being replaced by new bonds at today's far higher rates. The government is rolling over a mountain of debt from a near-zero world into a much more expensive one. Bigger debt, higher rate, relentless refinancing. Multiply those 3 together, and you get an interest bill that has exploded, past the entire defense budget. Here is the part that should be tattooed on every trader's monitor. This creates a genuine feedback loop, and feedback loops are how slow problems become fast ones. Follow the circle. The government runs a deficit, so it borrows. The borrowing adds to the debt. The larger debt generates a larger interest bill. But here's the trap. That interest bill is itself a government expense. It makes the deficit bigger. A bigger deficit means even more borrowing. More borrowing means more debt. More debt means a still larger interest bill. Interest feeding the deficit feeding the debt feeding the interest, round and round. Economists call it a debt spiral, and the defining feature is that it can become self-reinforcing. Now add the market's role, because this is the part traders must understand. The government can only borrow at rates that buyers, the investors who purchase treasury bonds, are willing to accept. If those buyers look at the spiral and start to worry, they demand a higher interest rate to keep lending. But a higher interest rate makes the spiral worse, which can make buyers demand even more. The bond market is both the spectator and a participant, and that is the force we are going to trade around, not on a single date, but as a direction. So you have a structural force, a debt load whose carrying cost is climbing and feeding on itself. When that force is in motion, 3 things tend to happen, and each one points to a trade. First, when a government leans this hard on its own currency and credit, the historic refuge has been hard assets, the things a government cannot print. Second, a market nervous about government debt and a stubborn inflation backdrop tends to reward companies that own real, inflation-linked, hard-to-replace physical assets. Third, there is a specific kind of financial business that can actually earn more when interest rates stay structurally higher. So I'm going to give you one vehicle per layer. 3 names. 3 different ways to express the same macro bet. Name 1, the iShares Bitcoin Trust, ticker IBIT. You might be surprised that I'm opening the debt spiral trade with this. Stay with the logic because it is the cleanest expression of one half of the thesis. This is an exchange-traded fund that holds Bitcoin directly. When you buy a share, you own a fractional, custodied claim on the underlying digital asset inside an ordinary brokerage account. Now, why does that belong in a debt spiral discussion? Step back to the core problem. A government with a spiraling debt has, historically, a limited menu of ways out. It can cut spending dramatically, politically brutal. It can raise taxes dramatically, also politically brutal. Or it can lean on the quiet option. The quiet option is to let the currency itself do some of the work, to allow more money to be created, which tends, over time, to erode what each unit of that money is worth. An eroding currency makes a fixed pile of debt easier to carry, because the debt is repaid in money that is worth a little less. It is the path of least political resistance, and history is full of governments that have walked it. So if you believe the debt spiral raises the long-run pressure to let the currency erode, you want to own something whose supply a government cannot expand. And here is Bitcoin's single defining property. Its total supply is capped by its own code at a fixed number of coins. No government, no central bank, no committee can create more. It is, by design, the opposite of a printing press. Here is what changed and why this is now a serious instrument rather than a fringe one. For most of its history, owning Bitcoin meant navigating unregulated exchanges, managing your own digital keys, and accepting real custody and security risk. For a serious investor or an institution, that friction was often a deal breaker. Then the regulated, exchange-traded Bitcoin funds arrived. That was a genuine structural change. It meant that a pension fund, a financial advisor, or an ordinary investor could now take a position in Bitcoin the same way they buy any stock, through a normal brokerage account inside a regulated wrapper with a large established asset manager handling the custody. The practical barrier between mainstream capital and this asset largely came down. And the response was dramatic. These funds attracted very large inflows in a short space of time, among the most successful fund launches in the history of the industry. Read what that means for the thesis. An asset with a hard-capped, ungovernable supply just became easy for the entire conventional financial system to buy, at exactly the moment that the conventional financial system has more reason than ever to worry about the long-run integrity of government money. A fixed supply asset meeting newly unlocked demand against a backdrop of an unfixable debt load. So how should a trader actually think about this position? Honestly, which means naming the other side of it clearly. Bitcoin is volatile, sharply, genuinely volatile. It can fall by large percentages in short periods, and it has done so repeatedly. It does not behave like a calm store of value on a day-to-day or even year-to-year basis. So this is not the sleep-at-night anchor of a portfolio, but here is the case, stated precisely. The debt spiral thesis is a long-duration structural argument. It plays out over years, not weeks. And over that kind of horizon, the question is not whether Bitcoin is bumpy. The question is whether you want a position in an asset whose supply is mathematically fixed as a hedge against the slow erosion of money whose supply is politically flexible. You hold it small. You size it for the volatility. You treat it as the hard asset, anti-debasement sleeve of the trade. And the regulated fund is simply the cleanest, most accessible way to hold that sleeve. No exchanges to vet, no keys to lose, just a ticker in your brokerage account. It is a small position with an asymmetric job to do well in precisely the scenario that would hurt conventional government paper. Now the bear case. 3 things to watch. 1. Volatility. This is by far the most volatile idea in the episode, and it can hand you a large drawdown even if the long-term thesis is sound. 2. Regulation. Government policy toward digital assets can change, and a hostile turn would pressure the price. 3. The thesis is long horizon. The debt spiral is slow, and Bitcoin can trade on its own unrelated dynamics for long stretches that have nothing to do with government debt. So how do you trade it? I am not going to give you a price target. Price targets are how analysts get quoted, not how traders make money. I will give you the framework. This is the small, high volatility, anti-debasement sleeve of the trade. Size down, held for the long horizon, doing a specific asymmetric job. Watch 2 things. First, the trajectory of the federal interest bill and the deficit, the raw fuel of the debt spiral thesis. As long as both keep climbing, the structural case for a hard supply hedge is intact. Second, the flows into the regulated digital asset funds. Whether mainstream capital is still steadily moving in. As long as the fiscal picture keeps deteriorating and institutional adoption keeps building, the role of this sleeve holds. If governments somehow get their deficits under genuine control, the core reason to hold an anti-debasement hedge weakens. That is your signal to reassess. Name 2. American Tower, ticker AMT. This is, in my view, one of the most elegant ways to own a real inflation-resistant asset inside a normal stock portfolio. And to see why it belongs in the debt spiral trade, you have to think about what that environment does to different kinds of assets. In a world of large deficits and sticky inflation, the assets that suffer most are claims on a fixed stream of money. A bond that pays a fixed coupon loses real value as inflation eats the purchasing power of each payment. The assets that hold up best are real, physical, hard-to-replace things that can charge more as prices rise. This company owns one of the purest examples of exactly that. It owns communications towers, the tall steel structures that mobile network operators mount their antennas on, tens of thousands of them across the United States and around the world. It is structured as a real estate company. It does not run a phone network. It owns the physical towers and rents space on them. And here is the beautiful part of the business model. A single tower can host the equipment of multiple different mobile carriers at once. The tower was built once, the land secured once. But each additional carrier added to that same structure is almost pure additional rent. The cost barely moves. The income stacks. Now here is the specific feature that makes this an inflation hedge rather than just a good business. The leases. When a mobile carrier rents space on a tower, it signs a long-term lease, often stretching many years into the future. And those leases very commonly contain built-in annual rent escalators, a clause written into the contract that automatically raises the rent by a set percentage every single year. Think about what that means in a debt spiral, sticky inflation world. The income from this company's towers is contractually programmed to rise year after year by a fixed step, regardless of what the broader economy does. The rent goes up automatically. The tenant is locked in by a long contract. The tower itself, already built, already standing, costs very little more to maintain as the years pass. So as inflation pushes the general price level up, this company's revenue is built to climb alongside it by contract, while its core asset base sits there, paid for, generating that rising stream. That is the difference between a bond and this. A bond's payment is frozen while inflation erodes it. This company's payment is contractually scheduled to grow. In an environment where the government is leaning on the currency, owning a stream of income that is built to rise is exactly the kind of position you want. The numbers that matter for this kind of company are specific. The first describes its core profitability, a measure of the cash the property portfolio generates, which real estate companies report in place of standard earnings. You want to see that growing steadily, year after year, driven by the rent escalators and by adding more tenants to existing towers. A steady, reliable climb in that figure is the signal that the inflation-linked engine is working. The second is the tenancy ratio, the average number of separate carrier tenants on each tower. Remember, the second and third tenant on a tower is almost pure profit because the structure already exists. So a rising tenancy ratio means the company is getting dramatically more income out of the same physical assets without building anything new. When the cash measure is climbing and the tenancy ratio is rising, you have a real asset business that is compounding its inflation-protected income from a base of steel that is already in the ground. That is the case. A hard asset with contractually rising rent that does not depend on the government keeping its fiscal house in order. And here is the kicker. Because this company is structured as a real estate investment trust, it is required to pay out the large majority of its taxable income to shareholders as dividends. So you are not just holding a hard asset with contractually rising rent. You are paid a steadily growing income stream directly while you hold it. A hard asset, an inflation-linked revenue model, and a rising dividend in one ordinary stock. Now, the honest catch, and it is the most important risk to understand. This company, like most real estate companies, carries significant debt because it borrows to build and buy towers. And here is the irony you must hold in your head. The very debt spiral environment that makes the towers valuable as an inflation hedge also tends to come with higher interest rates. And higher interest rates raise this company's own borrowing costs and can weigh on how the market values it. So the thesis has a genuine internal tension. The asset is a great inflation hedge, but the financing of the asset is exposed to the same rising rates the thesis describes. Read it correctly. This is why it is one leg of a basket, not the whole trade. It is strong on the inflation side and vulnerable on the rate side. And that is exactly why it needs to be balanced by something with the opposite exposure. The bear case. 1. Interest rate sensitivity. The company's debt load means a sustained rise in rates raises its costs and pressures the stock, even as the towers themselves stay valuable. 2. The mobile carrier customer base is concentrated. A small number of large carriers are the main tenants, so consolidation or tough negotiation among them matters. 3. Some of the company's growth has come from international markets, which add currency and political risk. How I think about the trade. This is the real asset inflation hedge sleeve, a hard, physical, income-producing asset with rent that climbs by contract. If you believe the debt spiral keeps inflation sticky for years, owning steel in the ground with built-in escalators is a sound way to protect purchasing power. Watch two numbers on every earnings call: the core cash flow measure and whether it keeps growing, and the tenancy ratio and whether it is rising. As long as the cash measure climbs and tenancy improves, the inflation-linked engine is healthy. If a sustained rate spike starts visibly crushing the company's financing costs faster than rents can rise, that internal tension is the signal to reassess. Name 3. Chubb Limited, ticker CB. We have covered a hard supply asset and a real asset inflation hedge, but both of those have a quiet vulnerability. They tend to do best when interest rates are not screaming higher. And in a debt spiral world, there is a real chance that rates stay structurally elevated for a long time, because nervous bond buyers keep demanding to be paid more to lend to a heavily indebted government. So a complete basket needs a third leg with the opposite exposure, a business that actually benefits from interest rates staying higher. That is a property and casualty insurer. This company is one of the largest property and casualty insurers in the world. It sells insurance. It protects homes, businesses, and assets against damage and loss, and it collects premiums for doing so. Now, here is the mechanism that makes an insurer a rate beneficiary, and it is one of the most elegant structures in finance. An insurer collects premiums today, but it pays out claims later, sometimes years later. In between, it is holding an enormous pool of money that belongs against those future claims. That pool is called the float, and the insurer gets to invest the float while it waits. This is the layer the market consistently underthinks in a rising rate world. The float is the key. A large insurer holds a vast investment portfolio funded by the float, and that portfolio is invested heavily in bonds, including government and high-grade corporate bonds. Here's why this is so powerful when interest rates are structurally higher. Think about what an insurer's bond portfolio earns. When interest rates are near zero, the float is invested into bonds that pay almost nothing. The giant pool of money generates a feeble return. That was the world for most of the last 15 years. Insurers had the float, but the float earned very little. Now flip to a debt spiral world, where rates are structurally higher, in part because the bond market demands more to fund a heavily indebted government. Suddenly, the same float, as its older, low-yielding bonds mature and get reinvested, is being put to work into new bonds that pay meaningfully more. The insurer did not have to sell a single additional policy. The exact same pool of money is now earning a far higher return simply because the interest rate environment changed. This is called investment income, and for a large insurer, it is a powerful, growing earning stream in a higher rate world. Read what that means for the basket. The debt spiral, by pushing rates structurally higher, is a headwind for a fixed coupon bond and a complication for a leveraged real estate company. But it is a direct tailwind for an insurer's float income. This is the leg of the basket that leans the other way. And here is the kicker. A great insurer has a second engine entirely separate from the float. It is the insurance business itself, the actual pricing of risk. A well-run insurer aims to collect more in premiums than it pays out in claims and expenses. When it succeeds, that gap is a profit before a single dollar of investment income is counted. The very best insurers, and this company is widely regarded as one of the best managed in the industry, have a long record of disciplined underwriting. They walk away from business that is priced too cheaply. They raise prices when risks rise. They treat the writing of insurance as a craft. So you get two engines working together. The underwriting engine, a disciplined insurance business that aims to profit on the policies themselves, and the float engine, a giant investment portfolio that now earns far more in a structurally higher rate world. Now, the honest catch. Property and casualty insurance carries genuine risk. A severe hurricane season, a major earthquake, a wave of large catastrophe claims can produce a bad quarter or a bad year. But read that correctly. That catastrophe risk is largely separate from the debt spiral thesis. It is weather and chance, not interest rates and deficits. And it is exactly why this company's reputation for underwriting discipline matters. A disciplined insurer prices and manages that catastrophe exposure carefully. You accept the catastrophe risk as the nature of the business in exchange for an earnings stream that grows precisely when higher rates are hurting other assets. The bear case. 1. Catastrophe risk. A severe season of natural disasters can produce large claims and dent earnings independent of the rate thesis. 2. Insurance is cyclical in its own way. After a stretch of high prices, competition can drive premium rates back down, squeezing underwriting profit. 3. If rates were to fall sharply, the float income tailwind would fade, since the portfolio would reinvest into lower yielding bonds again. How to trade it. This is the rate beneficiary leg of the basket, a high-quality insurer whose float income grows when the debt spiral keeps rates structurally higher. You watch two things: the investment income the company earns on its portfolio and whether it is rising as the float reinvests at higher yields. And a measure of underwriting discipline, the ratio of claims and expenses to premiums, which tells you whether the insurance business itself is being run profitably. As long as investment income is climbing and the underwriting stays disciplined, both engines are running. If rates fall sharply and the float income tailwind fades, the rate hedge value of this leg weakens. Now, and this is important, I would not bet the whole thesis on any single one of these names. I would think of them as a basket. Why a basket? Because this thesis has more than one way of playing out, and a smart basket holds a leg for each path. If the debt spiral resolves through the quiet option, a steadily eroding currency, the hard supply digital asset is built for that. If it resolves through sticky, persistent inflation, the real asset tower company with its contractual rent escalators is built for that. If it resolves through structurally higher interest rates, the insurer with its float reinvesting at higher yields is built for that. And notice the crucial design feature. The tower company is hurt by sharply higher rates, but the insurer is helped by them. Those two legs lean against each other deliberately. The basket is not three bets in the same direction. It is three different responses to the same root problem, arranged so that the scenario which hurts one leg tends to help another. That is what a hedge against an uncertain outcome actually looks like. You do not need to know the exact path because you own a piece positioned for each one. When you hold all three, the exposures roughly diversify each other while keeping the central macro bet intact. The government's debt now costs more to service than its own military. The pressure on the currency and on interest rates only builds from here, and owning a hard supply asset, real inflation-linked infrastructure, and a rate-benefiting insurer is how you position across the ways that pressure can break. One caveat. If you are going to trade the debt spiral theme, you have to respect its single hardest feature. The timing is genuinely unknowable. A heavily indebted government can carry an enormous debt load for a very long time before the market forces a reckoning. Years can pass. The spiral can grind on quietly while nothing dramatic happens. And a trader who bets on a specific date for a crisis can be early for so long that being early becomes indistinguishable from being wrong. So this is not a trade for a specific catalyst on a specific day. It is a structural tilt, a way of leaning a portfolio in the direction the pressure pushes, with assets you are content to hold for years. I do not know when the bond market forces the issue, but the direction of the pressure is not in serious doubt, and the basket is built to be patient. Position size accordingly. Do not max out on any single name. And keep dry powder for when a sudden scare about government debt sends markets down together, because that is when you accumulate. A few catalysts I am watching going forward. 1. The federal interest bill and the annual deficit figures, the raw fuel of the spiral. 2. The yield on long-dated government bonds, which is the bond market's live verdict on the government's credit. 3. Treasury bond auctions, specifically how strong the demand is each time the government goes to borrow. Weak demand is a warning sign. 4. The inflation data, which drives the real asset leg of the basket. If any single one of these key metrics cracks decisively, I will revisit the thesis on this channel. 2 more names to keep on a watch list, but I am not buying today. A gold exchange traded fund, the classic hard asset hedge against currency erosion, a close cousin of the digital asset idea. And Berkshire Hathaway, a company that holds a vast insurance float and a large cash position, Another way to own the rate beneficiary logic inside a diversified holding. I will cover both in future episodes when I have more conviction. Let me leave you with the macro frame. For decades, the debt of the United States government was treated as the closest thing the financial world had to a law of nature. Infinitely safe, infinitely absorbable, a foundation you simply built on without question. And for a long time, in a world of near zero interest rates, that treatment was not crazy. A vast debt at almost no cost is a vast debt you can carry quietly forever. But the arithmetic changed. Inflation forced rates higher. The old cheap debt is rolling over into expensive debt, and the interest bill has now climbed past the entire defense budget. One of the largest single line items in the government's books is simply the cost of money it already borrowed. And the spiral has a logic of its own. Interest feeding the deficit feeding the debt feeding the interest, with a nervous bond market watching every turn. This does not end with a single dramatic headline on a single day. It grinds. It builds pressure, slowly, on the currency and on interest rates, until the market is forced to take it seriously. That pressure, structural, directional, and underpriced by a market still treating government debt as a law of nature, that pressure is the trade. A hard supply asset, real inflation-linked infrastructure, and a rate-benefiting insurer are not a bet on a crash. They are a way to lean a portfolio in the direction the arithmetic is already pushing. The math does not care about politics, and the math has already turned. 3 vehicles, 3 layers of exposure, 1 macro bet. The digital asset fund hedges the printing press. American Tower hedges the inflation. Chubb earns more as rates stay high. If the thesis is right, the basket holds up across the paths. If the thesis cracks, you will see it in a handful of specific metrics, and I will tell you here. That is the trade. That is the headline behind the headline. If this kind of breakdown is useful to you, the kind where we do not just react to the headline, we trade behind it, hit subscribe. I will see you on the next one.